pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, if I could do a roll call, starting with Neil.
Here.
Okay.
Dave Olson's here.
Michael Shostak, Treasurer.
Dave Petoskey, Chairman.
Rena Emmons.
Jason Tice.
Thank you. Any public comment? Seeing none, we'll move on to the minutes. If we could approve the minutes from August 1st, 2024.
I second it.
All in favor?
Aye.
Aye. Any opposed? Hearing none, they're approved. If we could go over the quarterly review, I'll turn that over to Michael
Sure.
to start with that.
All right, I'll just do a quick update. So operating funds saw a rebound last quarter, finishing at $87,502,588. We keep those funds in our checking account. We target about $2 million in that account every day. Fluctuates a little bit depending on the ins and outs. From there we have a layer of a backup with our JP Morgan money market fund. And then that's the most liquid and available and still be able to earn interest. Then we move to our local government investment pools. We use MI Class, and we've been earning a pretty good return with them. Up until the 50 basis point rate cut, we were earning about 5.4%. Now we're hovering right around 5, maybe a little less than 5, 4.9. And obviously, as rates come down, we'll see that get affected the most. Then comes our bond portfolio. We hold that portfolio at Fifth Third Securities and Huntington Securities. Got a portfolio of short and longer durated bonds, governments and agencies. And then we have some bank CDs as well. So we earned $1.1 million in interest for the quarter. And I expect that next quarter, as we begin our winter tax collections, we'll see an increase again in that cash level. So those are our operating funds. Our pension plan, we will turn it over to Brian Green. Let me just, before he starts, our Empower Guaranteed Deposit Account. So that's the account that Empower keeps to be able to fund the monthly checks to our retirees, ended with a balance of $119 million, almost $120 million. That's a stable value fund, and that's what's used to fund our commitments to our retirees. The rest of the portfolio that Brian advises us on are more for long-term commitments to our retirees. So with that, for the equities portfolio, I will turn it over to Brian Green from Mariner Institutional.
What's the rate of return we're getting on the Empower money?
The Empower money right now is about 3.5%.
Okay, thank you.
Yep.
Hey. Hi. How are you?
So I'm going to start on page 2. This just resonated. Michael's comment around the assets used to pay benefits on a near-term basis are all with the Empower Guaranteed Account. But what we're talking about here is the long-term investment pool. And I'm just going to look at the bottom line of page 2. So it says April 2014 to September of 24. So this really measures the period of time from when the township undertook the issuance of bonds, right? We're going to take on debt to offset this liability. And I feel this line is so powerful, and I do this with other communities like West Bloomfield that's done that, Royal Oak that's done that, that's taken the step to issue debt, right, for the arbitrage, right? And the idea is if we can make more money in risk assets that we can in the debt issuance. So $84 million in portfolio value back in April of 2014. We've had net cash flow out of this portfolio of $39.6 million. Those are assets that have transferred into the Empower Guaranteed Account to make benefit payments. The market between stock price appreciation, dividends, other investments, has added $65.5 million, or the number that I look at, net of fees, the return over that time period, 8.7%. And I would argue, I got to go back a bit to think of where rates were in April of 2014, but let's say that was at 4.5% or 5%, and we've made 8.7. So I go back to, the decision that was made years ago to issue that debt has been and continues to be positive for the township. And I mentioned this, and I preface, and Dave mentioned that he had heard some of the presentation earlier with retiree healthcare that I was going to change my jokes, but he said he didn't hear any that were funny, so I don't have to change them. They weren't jokes then, they were just statements. But I'll take you to pages 6 and 7. And I always try to think of a theme when we talk about quarterly results. And the best one that I could come up with is what I have for you is good news, not great news. Good news from the standpoint of we made a fair amount of money this quarter, but didn't make as much as we could have. So that's where it's good news, not great news. And I'll spell that out. Top left-hand corner of page 6, you can see for the quarter, the overall DB equity portfolio, although it's now the DB equity, real estate debt, and private equity portfolio. It's not just U.S. stocks and international stocks. Was up 6.16% for the quarter. So that's the good news, right? We made 6%. But the not great news is the index for that same time period was up 6.7. So we made a good amount of money for the quarter. We didn't make as much as we could. But I'll still, all day long, be happy with a 6.1% return compared to a 6.7. So where did that come from? Ancora, slight underperformance for the quarter. You see up 8.9 versus their benchmark up 9.4. If you'd have told me the market, large cap value stocks are going to be up 9 and change, I would have told you I would expect a dividend-focused portfolio, which is what that Ancora portfolio is, would have lagged a little bit. So to only be essentially a half a percent behind, I would say is a success. The two biggest drivers of their underperformance were an overweight to Microsoft and an overweight to Qualcomm. And if you've heard David Sowerby speak, he's always referred to Qualcomm as the poor man's NVIDIA. It's a way kind of on the value side of getting into and playing the AI side of things. Fidelity S&P 500 Index Fund, no surprises, up 5.9%. Edgewood underperformed again for the quarter. Continue to recommend patience here. You see up 0.4 versus benchmark up 3.2. It's not so much what they owned, it's what they didn't, with less exposure to Apple and Microsoft. Clarkston, I will allow them to speak for themselves, although I will tell you that if not knowing anything about the results for the quarter, if you told me that small and mid-cap stocks were up 9%, I would have expected them to underperform, right? Quality bias, has cash in the portfolio. You see significant rally in a given quarter, I would expect a high-quality manager to lag. So we were actually pleased to see they were up 6.6% versus their benchmark up 8.7. Earlier in the year, we took efforts to further diversify the small mid-cap portfolio. So we actually reduced our exposure to Clarkston and added the Reinhardt Partners portfolio. It's about a 35 to 40 stock portfolio. Teams based in Mequon, Wisconsin, which is a Milwaukee suburb. Matt Martinek is the lead portfolio manager. Great start to the relationship. You see for the quarter up 9.7 versus their benchmark up 8.7, led by U-Haul and a number of regional bank holdings. First Citizens, First America. From an index fund standpoint, Fidelity Extended Market Index Fund, no surprises. You see up 8 and change, right in line with their benchmark from a long-term standpoint. Flipping down to page 7, from an international equity standpoint, we saw nice outperformance from Oakmark. You see up 8.9% versus their benchmark up 7 and change. Biggest driver of their returns was Alibaba. I don't know how much people pay attention to what's going on in China, but near the end of September, Chinese government announced a massive stimulus package, and in a 4 or 5 day time period, we saw the Chinese equity markets rally north of 20% in a week. So having exposure to anything in that space is going to drive outperformance. So that was a helper to Oakmark. It actually hurt JP Morgan because they're underweight China and overweight several other countries. So JP Morgan was only up 4.5% for the quarter versus their benchmark up 8.7 because of that underweight to China and not participating as much in that huge rally. The other, I would say, pleasant surprise, it's hard to get excited about this, but The real estate portfolio is actually in positive territory for the quarter. We don't yet have results in for TerraCap. We expect them to be flat, maybe even positive, just from the fact that interest rates have come down, so they're going to have a mark-to-market on the debt inside of that portfolio. But Principal actually saw positive news. You see up 0.8% for the quarter versus benchmark that was up 0.25. So we're finally starting to see what appears to be some bottoming from a commercial real estate standpoint. And that's, again, it's really hard to get excited about a 0.8% return. We just talked about the S&P being up 6 and small cap stocks being up 9. But considering the consistent down 5, down 7, down 6, down 8 that we've seen on a quarter-by-quarter basis out of commercial real estate, to come in and say it's in positive territory is a really, really nice turn. And starting to see more transaction activity and things really start to unthaw in that part of the portfolio and that part of the capital markets. The other change that you'll see, so if we fast forward and we're sitting here in February and looking at 12/31 results, is you're going to see 2 new lines added here, Bloomfield Capital. So the real estate debt portfolio was added. Capital call was made in October for about 60% of the commitment there. We expect the balance of that to be called between now and January. They've commented that in the history of their running this, which is about 20 years, they've never had this level of deal volume and deal quality. So that's another sign that we're seeing of people coming in and starting to be active on the commercial real estate side, where they're seeking out an opportunistic lender like Bloomfield Capital because the banks are out of it right now, which will be good news for the portfolio. And then Capital Dynamics, which is the private equity secondaries portfolio. Memory served, they called, I think it was between 10 and 15% of the commitment. Wasn't as much. That is one that will be slower to be put to work. Both of those were funded by reducing exposure to the domestic equity portfolio. And you'll see those lines added when we look at this for the 12/31 report. So as I'd mentioned, good news, not great news. Pleasantly surprised with the rally that we've seen out of the equity markets. I did want to I kept my comments tight in respect to everybody's time because we do have Clarkston in for a deeper dive and conversation around their portfolio. That's the extent of my prepared comments, but I'm happy to answer any questions.
Just a quick minute or two on the outlook for the next end of the year, which is real short, but going into 25.
Do you have a quarter? Flip it. I thought about grabbing these as I came over. Right, there's always this. Okay, if it's a Republican in the White House, energy stocks are going to do well. If it's a Dem in the White House, we expect clean energy to do well. And our research team went back and looked at S&P 500 performance during Trump's tenure versus energy stocks, because the thought coming into the Trump presidency was drill, baby, drill. The S&P 500 crushed it. So energy didn't do well. Did in the first kind of 6 months of his presidency and then waned. And then the thought coming into a Biden presidency was oil stocks are going to languish and clean energy is going to crush it, right? We're going solar, we're going wind. There's no more coal, there's no more oil. And the S&P 500 crushed clean energy stocks. So this thought of where we're going to lead and what's going to happen from a policy standpoint doesn't change. The piece that I would leave you with is if we look back over 70 years, so post-World War II, presidential terms, right? And what's the combination? Is it a Republican in the White House, a Dem in the Senate, a Republican in the House of Representatives? Is it all blue? Is it all red? The worst combination, the worst two combinations is either all blue or all red. The best combination is some mixture. And that's because if it's all blue or all red, things get done because the parties are aligned. And if it's some mismatch, particularly if the House and Senate are different parties in power, nothing gets done. And Wall Street loves it when nothing gets done because that means economic policy doesn't change and new laws don't get passed and taxes don't change. So the long-term view is we want a mix of parties in power. I will tell you the short-term view is I think we're going to continue to see rate cuts. The fixed income market has said the Fed's behind the curve and has missed it. I think the equity markets have said the Fed's got it right. So I think as we continue to see the Fed cut rates into 25, you're going to see the equity market continue to rally.
Perfect, thank you.
I have a question. Brian, can you expand on TerraCap's performance? That's the one that I'm really concerned with.
Yep.
You don't seem as concerned, but we're at almost 3.5 years with them, negative 7+%. And then I'm looking at the property index and I'm thinking, why wouldn't we just go with the index?
Yeah, so the index, unfortunately, on the real estate side is not something you can own. That is just a combination of commercial real estate properties across the country. So it's just kind of used as a reference point or a comparison point. So, whatever column you look at, don't get excited about the quarter being zero. That's just because that's the June 30 price. Like, they haven't published their 9/30 statement. That's going to come out probably in the next week and a half. The issue that TerraCap faces is, so we invested in 21. The portfolio had their final investment done in early 23, and they appraised every single property at the end of calendar year 23. And the issue with appraisals is it's recent sales volume, recent sales activities. And any of the sales activity that happened at the end of 23 were distressed sales. Not a bad piece of property, but it was a seller that was underwater and, I bought the property for $10 million, took out a loan for $6 million. Now it's only worth $7 million, and I can't get it refinanced, right? So the issue TerraCap faced was all of our properties are leased up, our debt's fine, like we have no concerns about needing to refinance anything, but because we have to go to recent transaction activities to mark to market, and the apartments that they owned in Tampa, when they looked to recent sales activity in the fourth quarter of 23, those were distressed sales that were down 30 to 35%. That's where they had to market. So it's not, for us, something that TerraCap's done wrong, and it's more an unfortunate spot in time of when they mark the portfolio. I would expect them to probably try to aggressively mark or reappraise the portfolio here, in December again, because interest rates have come down, so cap rates have moved up, so prices have moved up a little bit, and should see some good news in the fourth quarter. The other piece that gives me a bit of patience is they don't have to sell anything, right? That's a closed-end fund. Typical life here is 7 to 8 years, so we're a little over 3 years into it. Some of the properties have only been in that portfolio for a year, so they still have a lot of time to execute on their business plan, to increase rents, increase the quality of the tenants, do all of the things they need to do to increase the value of the property, and then sell it to a core buyer, somebody that's seeking a really, really high quality piece of property.
To follow up on that, so knowing that they've been somebody that we've been kind of concerned about, who is, if you were to switch, if we can't, I didn't know that we couldn't get the benchmark either, who would be your next choice and where are they at right now? If you were to compare them based on today.
That number, so for, so that portfolio, it's value add real estate. So it's not a trophy Class A property that they're buying. They're buying, the 300 unit apartment complex that was built in the 70s that was last remodeled in the 90s, right? So they need to come in and spend, $15,000 or $20,000 per unit, new carpet, new paint, new appliances, new HVAC, right? And bring it up to current specs. That's value add real estate. When we look at competitors, I won't say peers, but they're all competitors in this space, the returns in the last couple of years are pretty similar. And that's just a function of we're buying properties that need work. Interest rates moved up, prices moved down, right? It's the teeter-totter effect from a commercial real estate standpoint. And anybody that had to mark to market, right, they had to value their portfolio at the end of the calendar year because, as I'd mentioned, that transaction volume, the transactions that did happen were at depressed prices, even though they have no plans and no need to sell at those prices. From a professional standard standpoint, we have to price it based on what's in the market. It doesn't, right? It's the old, like, I think my house should be worth $250,000. My neighbor sells his for $200,000. What's my house worth? Well, if I get an appraisal on it right now, it's only worth $200,000. Even though I have no intention of selling it, I'm going to hold it, and I need to sell, 3 or 4 years from now. Like, there's the opportunity for that to recover. This is, the unfortunate, I don't think victim is the right word, but because they're required to, price their portfolio every year, the pricing inputs they had into it caused this, and we've seen it, across the board. The other piece to keep in mind, if you go back to, this is private real estate. There's also publicly traded REITs, so publicly traded real estate stocks, right? Taubman Brothers, so lagging indicator, leading indicator from an economic standpoint. So the stock market's a leading indicator. Stock market declines before a recession happens. Stock market rallies before we come out of a recession. So it's a leading indicator of economic activity. Unemployment is a lagging indicator. So stock market declines, then we're in a recession. We're in a recession for a couple quarters, right? Companies have to start cutting costs, start cutting employees. So unemployment spikes, we come out of the recession. So unemployment is a lagging indicator. Publicly traded real estate, leading indicator, right? It's publicly traded stocks. In calendar year 22, when interest rates rose, S&P was down 20%. Whether you look at it, right, whether it's retail, office, industrial, multifamily, so those sectors in publicly traded real estate stocks were down between 35 and 55% in calendar year 22. So the leading indicator for commercial real estate was down between 35 and 50%. Office was the worst. So leading indicator was down 35 to 50. Commercial real estate prices, private, are a lagging indicator. So TerraCap being down 35% in the last year is not outside the realm of what we saw on the public side of things. And we've now seen publicly traded real estate stocks rally significantly. So, okay, leading indicator told us down 35 to 50% on the public side. Here, 2 years later, private's down 35. Leading indicator today is up 30 to 40%. Okay, a year or two from now, if this same, history doesn't repeat itself, it rhymes. So if they follow each other in a similar pattern, we'd expect to see a decent rally in private commercial real estate. That would be a benefit to TerraCap. That would be a benefit to Principal. You're already starting to see it in Principal. It's hard to get excited about a 0.8% return, but that was positive appreciation in the value of their assets, right? Prices, the value of their assets increased because they appraise stuff. Let's say they have 100 properties in the portfolio, 25 get appraised each quarter. So over the course of the year, everything gets appraised, but it'd be physically impossible for them to appraise all of their assets, in the fourth quarter of every year. So they do 25% each quarter. So starting to see signs of life, starting to see signs of recovery, that's where we have some optimism in the future news out of TerraCap.
And I can add that it's very similar to some of the private real estate that I follow. Mm-hmm. So they all went down similar from a mark to market. They're fully invested funds. And now all the NAVs are starting to go back up, 5 cents a quarter, 10 cents a quarter slowly. And I echo what you were saying with the interest rates. Everybody, that portfolio sector was shocked, right? Yeah. And they lagged. So my experience is to see most of the same thing with good quality real estate in similar sectors to, apartments, industrial,
yep,
and so on. So, and again, office buildings getting hit the hardest. But this very similar, as long as you're telling me there's not a distressed piece in there that they're worried about, and it's that gives me a little bit better feel. But
and
I have not looked at their
portfolio. Most of that portfolio is industrial and multifamily. I don't. If there's an office building in here, it's going to be in like Phoenix, Scottsdale, Orlando, like an area where office is actually doing well, they're not buying, a 65-story office building in Midtown Manhattan. Those, or San Francisco or Seattle, like those are the markets where office properties are down 60, 70% from where they were a couple years ago. This is all Sun Belt, and this is all multifamily. This is all apartments and storage. Great question. Great questions. Clarkson? Yeah.
Sure.
Floor is yours.
Well, good morning, everybody.
Morning.
Thank you for having us. Really appreciate the chance to be here. We know how important the account we manage is to your overall pension and to all the retirees and employees of Bloomfield Township for which this exists. So thank you. Also, a special thanks to Brian and his team at Mariner for all your help getting us here and setting this meeting up. We really appreciate that. My name's Kurt Tarian. I've been at Clarkson Capital for 11 years now. I've had the pleasure of serving in this relationship since it started in 2018. Joining me is Jeff Hackla. Jeff is our CEO, our Chief Investment Officer, and co-founded the firm along with his brother Jerry back in 2005. I want to start by just saying thank you for your trust over these past 6 years. Thank you for your patience. Our investment approach, for those of you who have known us over those period of years, is very understandable. It's very logical. But it can also be frustrating at times when we're not in favor with the market, and this is certainly one of those moments. So thank you for the opportunity to come here. Thank you for the chance to explain why we underperformed and explain why we remain highly convicted in our approach in the portfolio we have here. I've been in the industry since 1992, so I've had the chance to present really good numbers, really bad numbers, and everything in between. And if there's a silver lining in this at the moment, I think the best period of time to ever really sit down, analyze a manager is when they're dislocated. That could be good, it could be bad, but when you have these extreme differences, again, be it positive, negative, you really get to understand, all right, what is this manager looking for? What type of businesses do they want to invest in? And how is that in favor or out of favor with the market? So, we are in one of those periods right now. It's been a more prolonged period than I think any of us would have imagined. But again, a good opportunity to really talk to Jeff, understand the types of businesses we're investing in on the pension's behalf and why we think it's the best place to be. We understand we have about 20 minutes. Is that an appropriate time? Okay, great. Well, what we plan to do with your time is first start kind of where we left off our last meeting. We talked about a company named Altice, and it was a very large holding in the portfolio, and we want to talk to you about how that experience ended, what we learned along the way, as that was a large detractor of performance over these past couple years. We'll then discuss previous periods in our firm's history. So Jeff and Jerry have been managing money since 2005. We'll talk about previous periods where we underperformed and then show you how we recovered and ultimately beat the market throughout those time periods. And then we'll just wrap up with more talk about why we are convicted with this current portfolio. So does that sound like an appropriate agenda? Okay. We have books. We'll reference a few pages. I promise you we're not going through all those pages. Stop us at any point. This is your time, your money. If something doesn't make sense, you need us to rewind or explain it a little bit further, by all means, stop us on the fly. All right? Jeff?
Well, thank you all very much for inviting us today to present. And again, thank you for your continued trust and opportunity to serve Bloomfield Township. It's interesting. The last couple of years have been frustrating for you all, and I know that, and I thank you for your patience. But I want to remind you of 2022, which feels like it was forever ago. But 2022, the portfolio was positive in a market that was down almost 20%. And you go back and you dissect that. And I'm starting here, I'm going right into it, and then I'm going to get into Kurt's other points. And if you look at 2022, we had 4 of our businesses in the portfolio that were purchased, meaning they were purchased by another company, and we saw a rapid appreciation in their stock price, which what it did was it pulled forward a fair bit of return, meaning when you have 4 companies that represented almost a third of the beginning value that were purchased, and I think that's a really important point to note. Our 3-year number, we have outperformed the market, and that's through 9/30 of 2024. And what's interesting with that was, unfortunately, we brought a ton of the return relative to the index in a very short period. And then during that year, we also sold a company, Western Union, and we trimmed LPL, what David knows so very well, because as rates were rising, the share price rose rapidly. And we turned around and took all that capital and we put it in businesses, Altice being one, which I'm going to talk about. We invested it in many other companies. And that happens to be one of the periods of time where we had a new vintage of companies, sort of like, Brian's talking about private equity, or I'm sorry, private real estate. And that has had a huge impact on why you've seen lopsided returns because of that big pull forward. I want to remind everyone of that. The second piece is, which I'll get to in a minute, and then I'm going to get into Altice, is when you look at periods where we underperformed, most of the time there's a negative market when we sort of then outperform the market again. If you go back and look at the global financial crisis, 2011, 2015, 16, 18, and COVID in 2022. And so we've been a manager that's tended to win on defense if you do that relative to the benchmark. And another point to note is you were able to take out $3.5 million in 2022 from the Clarkson portfolio. And what I'm proud of is to say that money hadn't declined that year, so you're able to get your money back at where it started that year. So I wanted to start with that before I go into the items that Kurt talked about. Let's talk about Altice. Altice was a huge disappointment. And I want you all to know my life savings is in these strategies. So when you feel pain, I feel lots of pain, because I don't have Brian picking 10 or 12 managers for me. I have one manager, Clarkson Capital. And I'm very happy to have Clarkson Capital as my manager, because we've been doing this for 20 years, and we've delivered double-digit returns for 20 years. And I personally like the feeling of not going down as much in those rough markets. But I think it's important to understand that alignment. Now, what happened with Altice? We had a lot of cash for quite a while, as you guys probably remember. You guys probably were saying, when are they going to put that capital work? When are they put the cash to work? And I remember telling Brian and others, I'll guarantee you 2 things. I'll put it to work, and 2, I'll do it when it hurts most. Well, this thing called COVID came out, and what is this? What's going to happen? We had these wonderful opportunities to invest. We got it all put to work, and I was really pleased with that. The market ripsaws back up, and we're looking around, looking for value, doing our best to stay fully invested. And we come across Altice. Altice is a cable company. It's a broadband company. I think we've all learned that we can't live without broadband. It is a utility. It's unregulated, which allows for it to be a profitable industry. We probably all, many of you use Xfinity. That's what I use, because it's geographical. Altice is not here. Altice is in 20 states, not Michigan. And when we looked at the business, we thought, what a wonderful business. We are going to be using broadband forever. And so we thought this is going to be a great opportunity. We knew they had elevated leverage. Rates were low. At that time, they were very low. Today, they're still pretty low to be at if you go back and look at a 50, 60-year history. And we ended up investing a fair bit of capital. So we went back and said, where did it go wrong? And the first thing was, when you have a business that was on a capital cycle of that, you had rapid growth. And when you have rapid growth, you're going to attract competition. Well, remember DSL? Did anyone ever have DSL? Well, you had, AT&T or Verizon. They underinvested in DSL, and cable ate their lunch. Well, what did they do? They decided to overbuild fiber on top of that DSL. So now cable had a formidable competitor. Some of you may switch back to AT&T. I'm trying to use a local reference. Plus, you had all these private equity came in and deployed a ton of capital in just doing general fiber. So you had a sense of competition. Plus, our cell phones, which are wireless, that you had an opportunity to switch to fixed wireless. Fixed wireless being, and it was an alternative. So you had substitution that came into this wonderfully profitable industry. And so at that ended up creating competition that was unanticipated. The second piece is, with the elevated debt, when you had the unanticipated competition, they had to raise spending on the income statement, which reduced profitability, and interest rates went up. It was the perfect storm against them, and that was why the company was harmed economically. And I want to remind you, yes, we did sell out, but there was a company, Cable One, which is in the similar industry, and we feel like Cable One is a better company than Altice. We actually owned Cable One before you all hired us in 2018. That was a wonderful business. It is a wonderful business. So we ended up switching horses, so to speak, into Cable One. You say, well, Jeff, isn't it the same lessons? They have less debt. It's Don Graham, the Washington Post Graham family. They own 20% of it. We feel as though it's a better business. So I want to highlight that albeit you feel like it's over, there's an impairment of capital. We did invest in Cable One, which we think is a better provider. I do want to share that with you. But again, before I move on, any questions on Altice? The next question is, the question is, why should we stick with you? Wonderful question. Why shouldn't we index? These are all the questions you should be asking me right now. And if you go back in time and look at when Clarkson has trailed for 2 years, in one case it might have been 3 years, that next year ends up being an extraordinary year. And those years were 2008, it was 2011, it was 2015, it was 2018, it was 2020, and it was 2022. And in the 2020 was a piece of the year. The common theme there is we tend to win on defense. And Brian could say, well, we're not going to have a down market for 2 or 3 years. I have no clue. Did the coin flip? I don't know. But what I do know is when we've been out of favor, a lot of that is for a little extended period, being a couple of years. If you look at history, and there's a little slide in the deck that's going to show you, and maybe I should reference that page. It is page 9. And you will see all these periods of time, 2009 and 10, that was coming out of the GFC. It was boom, boom, bust. You look at 2012 and 13 were kind of boom, boom, and it was muted, and we had an extraordinary year. 16, 17, kind of boom, boom, bust. You look at 2019, 2020, there's that intra period of COVID. 2021 and then 2022, bust. You can see it's showing, you don't see a line because we were slightly positive. Now you see 23, 24. I don't have a crystal ball for 25 or 26, but what I do know is we own extraordinary businesses. My life savings is in these businesses, and I couldn't be more excited with the portfolio today. What I will say also is that we've gone back for 20 years, and we have an underwritten return. What do we expect the next 10 years, the next 7 years, which is that full market cycle? And we've earned about an 11% return on our money since inception, and that would be the average. We are right now underwriting or predicting or forecasting slightly better than that the next 7 or 10 years. I will remind everyone, the last 15 years has been the best market I've seen since the late 90s, right? And it sort of reminds me of the late 90s. The late 90s were led by Cisco, Microsoft, and Intel. This is led by other very large tech companies. Back then, when you became a $500 billion company, you became the trophy. Now when you're a $3.5 trillion company, you become the trophy. And so the market's very reminiscent of that period of time. And I look at what we own today. We own battle-tested businesses, beer companies. We own insurance companies. We own food companies. We own niche industrial companies. We own some healthcare services businesses. These are businesses that are going to thrive whether we have a Republican, whether we have a Democrat, whether we have a split situation. Again, I can't predict the election. The market couldn't predict the election either. 2016, they thought it was going to be Hillary, and they thought if Trump came in, it was going to be an awful market. They were wrong. And so our job is to not try to predict the things we can't predict and try to predict how the market's going to respond. It's to put your portfolio in companies that you want to own, that I want to own. And that's exactly what we've done for almost 2 decades. And it's produced double-digit returns. And I will remind you, it's our market outperformance has tended to occur during negative periods. There's a great chart in here. There are 2 of them. It's the next 2 pages. This is kind of busy, but what we did is we went back and said all of the rolling 3-year periods. There's been lots of them, almost 200, because once you've been there 3 years, you got one, and then every month thereafter you get an additional one. And what you'll see is we're those orange dots. When there's a down market, you can see almost always we outperform that 3-year rolling. When there's in a down market, it's below 0. When there's a normal market, which is 0 to 10, we almost always outperform too. And then when there's that robust market, you can see we lag in about 30% of those periods. But I will remind you, when you look at the slope of that line, our slope is a little less. You wouldn't want to ski on our slope. You want to ski on the market slope when you look at that. And so that is just, again, an experience of the past. I can't promise that going forward, but we have the same team, we have the same process managing this portfolio like we did the last 2 decades. If I go into the next slide, we did it for 5 years. And there were not any down markets in that 5-year period, but there was many of the normal and there was many of the robust. We outperformed 92 of the normal, and I need my glasses, 71% of the up markets. So over the long term, we're a great manager, but in these short periods, we can be frustrating. But I want to remind you, 2022 was that period where we pulled so much return forward, and unfortunately, we're sort of giving it back. I'm going to pause for questions.
Jason?
Based on your comments on Altice, can you tell us how much was lost or how it affected our overall portfolio?
I don't have the specific number. We can get you that information. It would be, 3 percentage points probably the last 2 years per year, but I'm giving you an estimate. And again, Kurt can follow up with this specific information. But it did have an impact. Without Altice, you wouldn't be probably talking to me today because that 3-year number would be extraordinary.
Okay.
But, yes, sir.
Understanding that, I think maybe the central question that we've had going back is, in this situation, we do have the option of having, obviously, low-cost index fund, and why, maybe you can address why that isn't, isn't a policy that we ought to pursue.
Dave, it's a great question. The advantage of an index fund is it's a feel-good, right? You're always, whatever the market did, you did. Turn on the nightly news, boom, that's what you did that day, right? It's great, we're happy. If it's down, it's bad, right? So I would say to you, a third of the small cap index, approaching 40% of those companies lose money. So right there, by going the index, you're basically putting some of the township's money in unprofitable businesses. That's the negative why you wouldn't want to do it, right? Another reason why you'd want to be with a Clarkston is, again, I think the fact that we have smoothed out returns historically. I can't guarantee it going forward, but I would expect similar behavior going forward. And it allows you in a period like 2022, when you needed capital to fund payments to your pension recipients, you were able to take $3.5 million from us, and you didn't do it at a loss at that period of time. You're able to do it at a neutral period. So I think that becomes another useful tool for you and Brian. Yes, sir.
Part of your philosophy of being defensive and responding to a down market,
Yeah.
there's certainly value in there. There's been value to the township over the years. However, in the robust markets where you have done not as well,
Yeah.
moving forward, is your philosophy going to remain the same, that in a robust market you're still going to be underperforming compared to other companies that we invest with or managers, or is it to look to become more responsive in a robust market?
Yeah. When we choose our investments, we don't choose them thinking we're going to be competitive in a robust market or we're going to be defensive. It's the nature of what we own. We're looking to own quality businesses that are all profitable. We're looking to own businesses that dominate a micro niche. I'll give you the example, Energizer. And Energizer is an example of a business you own. You have Berkshire Hathaway's Duracell, and you have Energizer. They really, for 70 years, have participated in a duopoly in that industry, right? So that just tends to be a business. And again, I don't want to even mention names anymore. I should just, but anyhow, but I say that because I'm not saying it's the best name in the portfolio. I'm using it as an example. And the reality is, that's sort of what the market clings to there's a quality business, and there's value, and that's what the market has tended to do with our sort of behavior. But to go back and further delve into it, I look at what Goldman came out this past week, or maybe it was last week, can't remember, and said the S&P is a 3% market the next 10 years. And if I look at what we do, we're looking to get 10s. And I think our market we are way better than the market in a more muted period. And that robust market, we're going to likely lag. So if you want a kind of a beta manager or a robust manager, we're probably not the best manager for you. And again, as being a owner of an office building and a taxpayer in this town, I want what's best for Bloomfield Township.
I'm going to weigh in on that as well, right? So Jeff is going to operate in his vacuum, right, in his business, which is where he should operate. Take a step back and think about the overall portfolio, right? We talk about having a diversified portfolio. We've got large cap, mid cap, small cap. We've got international. We've got real estate. We've got private equity. So we've diversified where we're going to get our returns from, because from one day to the next, one quarter to the next, 1 year to the next, it's going to come from different areas. If we go back a year ago, our small cap portfolio was 50% Clarkston, 50% index fund. So market goes, when you think about it, that's diversification within the small cap area of where's the return going to come from. In a difficult market, we'd expect Clarkston to outperform. In a difficult market, we expect to be disappointed with the index fund, right? Like, you're down 20, you're down 20. In a positive market, we have the benefit of that index fund. The other piece that and the change that was made back Jan 1, adding the Reinhardt portfolio, Reinhardt has a tendency to outperform in positive markets and hang in there in difficult markets. So this idea of outperform in bad market, where are you in a normal market, where are you in a robust market? We've now diversified our investment portfolio to have different strategies that outperform at different times, right? If all we had was active managers that played defense, I'm not in equities to play defense, right? Like, if I think the stock market's going to go down, I want to own cash. I don't want somebody that says, hey, I know the market was down 20 and I was only down 15, so great job. So as we've built out the investment portfolio, we've not only diversified it by assets, stocks, bonds, or stocks, real estate, private equity, we've also diversified within the given asset classes on where the return stream is going to come from. And the idea being is, like, we just talked about results for the third quarter. For the third quarter, one outperformed, Reinhardt. One was in line, the index fund, and one underperformed, Clarkston. So there's a bit of a diversification there from where the return's coming from.
Thank you, Brian. Danny? What other questions?
Do you have anything in here that would show, so if we only really have a concern during robust markets and we're thinking long-term, do you have anything in here that shows how often of the last 10 or 20 years it's robust versus any of the others, so we can see and have that benchmark of, yes, it's down right now, but typically that's not the markets that you have to worry about?
We don't have that in the deck, but I want to remind you of when the market goes down 50, it's got to come back up 100. Okay. When the market goes down 30, it's got to come back up 43. So if you can successfully provide defense, over the long term, you don't have to always participate in the robust markets to outperform. I think that's an important point to note. And if you look at going all the way back to the inception of the strategy, which is almost 2 decades ago, we've outperformed the market. So even though, yes, we're a defensive manager, but we're a long-term offensive manager to outperform the market. I do want to highlight that.
Danny, I think you see a bit of it. Take a look at page 10. So this is, 17 and a half years of data, March of 07 to September of 24. So 3-year windows. Out of 12 out of 175 were in negative territory. 70 of them were between 0 and 10, and 93 of this, better than half were really, really good. So I think the answer to your question is, to the question of, like, how often is it a bad market? Not very often. I mean, you think about the S&P 500 on a calendar year basis is positive something like 80 to 85% of the time. It's a big number. I think from a psychological standpoint, we remember the great years. We definitely remember the bad years, and we never think about the like, oh, it was up 8%. Like that's like nothing, even though that's, that's a normal kind of average return. So if this, I think, were 1-year returns, it wouldn't have quite the same skew. I think there'd be more from a negative standpoint, but not, what is that, 6%, 7%? It's not like 20% of time periods are in negative territory. It might be a little bit higher. So in terms of bad markets, they don't happen all that often. But when they do, they're extreme.
But we're in robust markets about 55% of the time. Oh,
It's the beauty of the stock market. Every time you zoom out, the news looks good. Even when like the most recent news is bad, every time you zoom out,
But aren't we hearing that we're not doing well in robust markets? So if it's 55% of the time, that means we have to worry 55% of the time?
But
And again, I could be misunderstanding.
No,
That's why I asked a
so,
lot of
Annie,
questions.
here's my question to you.
But it sounds like that's what we're hearing.
So the question is, if you were to go back and look at, when the market's up 20, it's not like we're up 5, right? Based on history. We're just in those, when we trail, we've outperformed 70% of the robust markets, right? So in many of the markets, you're happy, right? There's just some of the markets in that period. And again, I want to remind you, when you go down 50, you got to come back up 100, right? So when you go down 30, you got to come back up 43. 43 is a tall task, but basically when you go down in half, which the market did that in the GFC, you got to double to get all the way back home again. Now, typically the market does, rebound out of that, but that is just the math behind long-term returns.
Any other questions? All right, well, thank you.
Thank you. And thank you all again.
Yeah.
Thanks, guys.
Thanks for coming.
All right, and then now we have the
Thank you.
defined contribution.
Yeah, just touch on that. So these are the funds that we are the fiduciaries for, but that the participants themselves choose their investments. We decide what funds they can invest in. Rob Higgins from Schwartz and Company helps me decide, which menu of funds we have. He's very satisfied with the funds that are there. Our participant-directed accounts saw a nice increase over the quarter from 61.6 million to 64.8 million. And so these are for our employees currently working for us, our actives, and their investments for their retirement that are not eligible for the pension. But nothing, I spoke with Rob, and typically we only review these with him at this meeting once a year in our January meeting. But I spoke with him and he said that there was nothing that needed updating at this time.
Any questions? No? All right, and then new investments. Is there anything we're going to talk about with new investments?
So as Brian indicated, we closed our investments or started our investments. We closed the deal, closed the transactions with Bloomfield Capital for our real estate debt investment and with Capital Dynamics for our private equity secondaries investments. We did start to see capital calls from them, and so we have been meeting those capital calls. There's one other investment in private credit with Marathon Capital that we're looking at. I expect that we would make that a first quarter of the year close for the pension fund, and again, that would fall under our alternatives basket. But Bloomfield Capital is is closing out our real estate category, and then Capital Dynamics and our alternatives. If you want to add anything to that?
Just that And as I'd mentioned, Bloomfield Capital's called about 60 to 65%. All of this activity was in October, so you're not going to see any of it in this book. When we look at the December 31st book, that's when you're going to see those added. And the Marathon portfolio is one that we'd expect if we choose to make the commitment. Their final close is scheduled for January 31st of next year. And that would be a pretty aggressive capital call structure because recall, we talked about that a couple times at previous meetings. That's a distressed manager. So they're providing rescue financing into companies. They're purchasing debt. A key example, Jeff had mentioned COVID. In March of 2020, Marathon was investing Fund 1. This is Fund 2. They were buying, doesn't necessarily seem like the best idea now, but Rite Aid and CVS debt. At the time, at like 60 cents on the dollar, and then because everybody, right, it's COVID, no one knows what's going to happen. UPS and a few others, like debt of like at the time very, very high quality companies, sold it 6 months later at par. So that's examples of just some of the underlying transactions, or a lot of what they had done was the Travelocities and the airline, travel booking services, airlines, and car rental companies. In COVID, all of that travel ceased. They provided rescue financing in a lot of those companies. I don't know if anybody's flown lately or if anybody's tried to rent a car lately, but a flight is pretty close to a mortgage payment now, and I think my car payment is maybe less than I just paid for a rental car for a couple days in Connecticut. So those businesses have come roaring back from a profitability standpoint. So those are examples of like where you see, you hear, oh, distressed manager, like it's a troubled company. It's a good company that's in a bad cash flow position because of some exogenic shock that's happened, and it's a great investment opportunity.
Okay. Any questions? No. Thank you, Brian.
Yeah.
Without that, anything else? I'm going to adjourn the meeting at, I can't see without my glasses. What time is it?
8:58.
8:58.
At 8:58. Thank you, everyone.
Thank you.